Okay, have you ever put your money into an investment and then just sat around, waiting for months, maybe even years, just for that very first interest payment to hit your account? It takes a ton of patience, right? But what if I told you there is an investment out there that actually pays you your interest on day one? Literally, the moment you invest, your profit is sitting right there in your bank account. I know, it sounds totally counterintuitive, maybe even a little too good to be true, but it's very real, and it's actually one of the absolute foundational strategies savvy investors use to protect and grow their capital. Hello and welcome to this explainer. I am absolutely thrilled to be your guide today. We're going to be walking through a comprehensive beginner's guide to Nigerian Treasury bills, often just called T-bills or NTBs. Look, if you've got some idle cash sitting around and you want to put it to work in what is widely considered the safest possible way, you are exactly where you need to be. We're going to completely strip away all that complex financial jargon and look at exactly how these instruments work as the ultimate tool for safely growing your wealth. Okay, let's dive right into this. Here is how we're breaking things down today. First, what are T-bills? Second, the discount mechanism. Third, safety, risks, and taxes. Fourth, choosing your investment tenor. And finally, primary versus secondary markets. All right, kicking things off with Section 1, what are Treasury bills? Or, as I like to call it, the absolute safest way to lend to the government. So when you strip away all the fancy terminology, investing in a T-bill is really just the safest way for you to become a direct lender to the government. Here's the formal definition. Treasury bills are short-term debt securities. They're issued by the Central Bank of Nigeria, the CBN, on behalf of the federal government. Now, why do they do this? Well, the government constantly needs to raise funds, right? They have budget deficits to finance, massive developmental projects to fund, the whole shebang. So essentially, when you buy a treasury bill, you are quite literally lending your own hard-earned money to the federal government of Nigeria. And in return for your help, the government promises to pay you back your principal plus interest, all within a maximum time frame of just 1 year. Now, you might be wondering how this compares to bonds, which are, another super common government debt instrument. The absolute biggest difference here is time. Treasury bills are strictly short-term. We're talking anywhere from a few days up to a maximum of 1 year. Bonds, on the other hand, those can stretch for years or even decades. Because T-bills are so incredibly short, they offer a short-term fixed yield with incredibly low risk. Bonds are going to offer those long-term periodic interest payments, but their risk can vary quite a bit depending on how the market shifts over those long decades. Bottom line, if you want a quick, super secure turnaround for your cash, T-bills are your go-to. Moving right along to Section 2, the discount mechanism explained. This is the fun part, how to get paid on day one. Honestly, this is the single most exciting mechanic of Treasury bills. Let's do a little mental math to demystify exactly how you get paid your interest right out of the gate. Let's say you decide to buy a treasury bill with a face value of 100,000 naira, and let's say the current interest rate or discount rate is 10%. Okay, step 1, you subscribe for that 100,000 naira bill. In step 2, the magic happens. The central bank actually discounts your purchase by that 10%. So instead of deducting 100,000 naira from your account, they only take 90,000. That 10,000 naira difference, that's your interest. And boom, you have it on day one. Finally, in step 3, when the bill actually matures, the government pays you the full face value of 100,000 naira. Basically, you just bought 100,000 naira for 90,000 naira. How cool is that? Because of this unique upfront mechanism, finance professionals actually call treasury bills a zero-coupon investment. There are no quarterly or biannual interest payments like you'd see with a bond. Nobody is going to chop up your interest and mail you a tiny fraction of it every 3 months. Your entire return is realized through that upfront discount. What that means for you is that your profit can immediately be reinvested or used to pay bills or whatever you want, while your principal keeps working its way toward maturity. All right, time for Section 3, safety, risks, and taxes. Let's do a quick reality check. First up, let's talk about the massive benefits. Why do investors absolutely love these things? Well, primarily, they are backed by the full faith and credit of the federal government of Nigeria. Practically speaking, that means there is zero default risk. As some financial analysts like to point out, if the government were truly in a bind, the central bank could theoretically just print more money to settle up with investors. Aside from being incredibly safe, T-bills are highly liquid. You can easily convert them to cash in the secondary market if a sudden emergency pops up. Plus, banks love them. You can very easily use your T-bill certificate as collateral for a loan if you ever need to. But, we gotta be real about the flip side, the trade-offs. Because T-bills are so incredibly safe, they naturally offer lower yields compared to high-risk assets like stocks. You're trading high returns for peace of mind. Furthermore, we really need to talk about taxes. Back in 2012, the government issued a 10-year tax exemption on short-term securities, which was great. But that period expired in 2022. So today, your earnings from Nigerian Treasury bills are subject to a standard 10% withholding tax, alongside some minor processing fees. And finally, there's the inflation risk. If the economy shifts and say inflation hits 5%, but your T-bill is only yielding 3%, well, your real rate of return is technically negative. Your money is perfectly safe, but its actual purchasing power might shrink just a little bit. Moving right into section 4, choosing your investment tenor. This is all about strategy and time. When you pull the trigger and buy a Treasury bill, you have to decide on your timeline. The shortest standard option on the table is the 91-day tenor. That is exactly 3 months. This is basically the perfect strategic choice for an investor who has cash sitting around that they know for a fact they'll need soon, maybe for upcoming school fees or a big planned purchase, but they want it to earn a little something rather than just gathering dust in a standard checking account. The next step up from that is the 182-day tenor, which is essentially 6 months. Now, the golden rule of tenors is this: when you agree to leave your money locked up with the federal government for a longer duration, they are going to compensate you for that extra commitment. So generally speaking, the interest rate for a 182-day bill is going to be slightly higher than the rate offered for a 91-day bill in that exact same auction. And finally, we reach the big one, the maximum duration, the 364-day tenor, or essentially a full year. If you absolutely do not need your funds for a full year, this is usually exactly where you want to be. Leaving your money for the maximum allowable duration typically yields the highest possible return out of the 3 options. It's also worth noting that you can earn a true yield that calculates out slightly higher if you choose to take your interest at the very end instead of upfront, but regardless of how you take it, that 364-day lockup is going to reward your patience the most. All right, on to our final building block, Section 5, Primary vs. Secondary Markets. Let's talk about where to actually buy these. So, you completely understand how T-bills work now, but where do you go to buy them? Well, this brilliantly illustrates the massive divide in the market. The primary market is where the CBN actually conducts their bi-weekly auctions. You can literally bid on your desired interest rate here. But to play in this space, you need a minimal investment of 50 million and 1,000 naira. Yeah. For most everyday investors, that is completely out of reach. But don't worry, because that is exactly why the secondary market exists. Through regular commercial banks and stockbrokers, you can buy fractions of already issued T-bills, and the minimum investment there, just 100,000 naira. So if you're taking the secondary market route, which most of us are, here is exactly what you need to get started. First, you have to have an account with a commercial bank or a licensed broker. We're talking institutions like Stanbic IBTC or Afrinvest. You're going to need that minimum of 100,000 naira, and any additional investments you make above that have to be in increments of 10,000 naira. Now, there are some minor fees to keep in mind. Usually it's around a 300 naira transaction fee and a tiny 0.05% custody fee on the face value. And hey, remember what we said earlier about liquidity? If life happens and you ever need your money back before your 91, 182, or 364 days are up, you can liquidate your investment at absolutely any time through your broker on the over-the-counter or OTC market. And just like that, we've reached the end of our beginner's guide. We've seen exactly how Treasury bills offer a highly secure, structured, and incredibly liquid way to put your idle cash to work. They're backed by the ultimate guarantee of the government, and they hand you your discount right up front. So what does this all mean for you? Take a look at your own savings right now. Look at your personal timelines. Which Treasury bill tenor actually aligns with your current financial goals? It's definitely something worth thinking about as you look at your portfolio today.